Hello and welcome to today's podcast dedicated to performance measurement of trading strategies. Traditionally, traders have most commonly used annualized returns to measure the performance of any trading strategy. This practice, however, presents a few challenges. For starters, some strategies are likely directional in nature. They could be market neutral, they could be leveraged, making purely the metric of annualized return alone a misleading measure of performance. And furthermore, even if two trading strategies have more or less similar annualized returns, the risk profile is still an important variable that requires measurement. For instance, a strategy with very attractive annualized returns isn't necessarily all that attractive if it's accompanied by unfavorably high risk that led to those returns or long waiting periods before the market eventually turns in that strategy's favor. Traders are therefore likely to prefer decent risk-adjusted returns over simply decent annualized returns alone. A metric called the Sharpe Ratio, therefore, aids this risk assessment and attempts to solve the problem of comparing trading strategies on a risk-adjusted basis, but it isn't without its flaws. In this podcast, we'll discuss some of the shortcomings of the Sharpe Ratio that render it a non-optimal tool for measuring the performance of a trading strategy. And for your convenience, the three themes we're going to follow here in order are, firstly, we'll discuss what is the Sharpe Ratio and what it is used for, where and how does the Sharpe Ratio fall short, and any alternatives for performance measurement, what they are. So let's discuss what is it that constitutes the Sharpe Ratio. And developed in 1966 by Nobel Prize winner William Forsythe Sharpe, the Sharpe Ratio is a measure of the excess return of any portfolio or trading strategy relative to its underlying risk. Originally, it was termed the reward to variability ratio and is commonly used as a risk-return measure in finance that describes how well asset returns compensate investors for risks they undertake. Mathematically, the Sharpe Ratio is fairly simple and can be expressed as the difference between the expected excess return of an investment or trading strategy and the risk-free rate of return. That difference divided by the standard deviation of said excess returns. The risk-free rate for the remainder of this podcast we'll assume to be zero. That is, 100% of your portfolio is assumed to be invested in risky assets. Now, while the Sharpe Ratio is certainly a decent measure to form initial impressions of risk versus reward, the remainder of our discussion aims to demonstrate why, on its own, it isn't adequate for evaluating a trading strategy's performance and hence unsuitable for guiding investment decisions on the whole. So, the next few items in our agenda here present a comprehensive but by no means exhaustive list of problems with the Sharpe Ratio in the context of evaluating trading strategy performance. The first of those is that the Sharpe Ratio assumes that returns are normally distributed. By making use of standard deviation, a measure that assumes returns to be normally distributed, the Sharpe Ratio cannot adequately quantify behaviors observed in real-world trading where asset profiles and time series profiles are usually not normally distributed, entirely at least. In reality, rarely are trading strategy returns concentrated within fixed standard deviations around said mean returns based on that theory. In fact, most strategies will demonstrate non-zero skewness and kurtosis, whereas a normality assumption will hypothesize that skewness is zero, and therefore it's prone to underestimating tail risk, and that's a problem. Therefore, if using the Sharpe Ratio, a trading strategy experiencing, for instance, a period of unexpected, very exceptional performance may lead to a significant deviation from normality, acutely biasing that performance evaluation and therefore misleading an investment decision. Over and above the assumption of normality, the Sharpe Ratio doesn't give us any further information about the strategy's actual distribution of returns. The second thing about the Sharpe Ratio is that it's quite sensitive to periodicity of strategy returns. So since the only component of the Sharpe Ratio's denominator, for instance, is the standard deviation, varying the periodicity over the same time interval will affect the output Sharpe ratio. This is due to the fact that excess return over the same time interval will stay the same, but the standard deviation of returns over different periods, for example, daily, weekly, monthly, etc., will be different. In terms of performance evaluation, this is a risk, since a more favorable Sharpe ratio on one time frame may possibly enforce a preference for that time frame and hence mislead an investment decision where the time frame becomes something that possibly contains the alpha for that particular strategy, and that's not entirely true in real-world trading, and certainly not a robust approach to follow. The Sharpe ratio is insensitive to the order of excess returns. Standard deviation as a measure doesn't consider the order of data that we pass through it. So let's say two trading strategies with wildly different paths to the same excess return. They could theoretically have the same standard deviation over the same time interval. Using the Sharpe ratio, it wouldn't be possible to adequately evaluate which of the two is a more risk-efficient candidate for investment. Indeed, upon visual inspection of such strategies, the investor may have excluded one or the other, regardless of its Sharpe ratio. The Sharpe ratio doesn't differentiate between upside and downside volatility. Now, once again, owing to standard deviation being the Sharpe ratio's denominator, large fluctuations in excess returns, even when those returns are positive, can effectively lower the Sharpe ratio. This is due to the fact that, one, an unusually large gain, and two, a similar sized drawdown. Both of these can potentially increase the value of the standard deviation more than that of the excess return over the same time interval. And that effectively penalizes both good and bad performance. This issue was addressed to some extent with the development of the Sharpe ratio, which takes only downside deviation, let's call it sigma downside, into consideration. It's a modification to the Sharpe ratio, the approach effectively penalizing bad volatility instead of all volatility. However, many of the problems with the Sharpe ratio, as we've discussed just now, also apply to similar variations thereof. A note on periods of inactivity that affect the Sharpe ratio. So by design, excess return over standard deviation, a strategy's Sharpe ratio will decline over periods of trading inactivity, despite no positions that is zero return, being taken during that time. To make this concrete, let's imagine that we have a strategy that so far has 12 months of non-zero returns. Choose an arbitrary number for each of those, bounded within 0, -5, and 5%. And let's say we come up with 1.5, 2.0, -1, 1.2, 3.5, -2.5, 0.241, 1.52, -1, and 1.2. Assuming a risk-free rate of 0, as we discussed earlier, based on these numbers that I just read out, the expected excess return here is 0.0105833. The standard deviation of these returns is 0.01889905, and therefore the Sharpe ratio based on the difference between excess return risk-free rate divided by the standard deviation comes out to 0.559928. Let's now assume that the strategy does not trade for the next month, and that would mean we tack on a month at the end of this existing series with a 0 return. Once again, assuming the risk-free rate is 0, we'll revise our expected excess return, and that new value will be 0.009769231. Revising our standard deviation will bring it to 0.018331, and our final revised Sharpe ratio is 0.5329349. So let's forget all the numbers we just discussed, focusing on two, before and after in terms of Sharpe ratio. The Sharpe ratio before the month with no trading was 0.559928, and the Sharpe ratio after the single month of no trading was 0.5329349. So what we've just observed is that the Sharpe ratio has penalized trading inactivity, declining by 4.83%. without the strategy taking any trading decisions over the last month. So this tendency therefore renders it non-optimal as a performance measure because a month of inactivity does not imply anything towards the quality of an investment decision or trading strategy. The Sharpe ratio also ignores serial correlation. Now, serial correlation, for those of you who are new to the subject, describes the relationship between individual returns over successive intervals of time. When serial correlation is present in a time series, it can smooth strategy returns and consequently bias standard deviation calculations of the time interval under study. In such situations, there is a risk of the Sharpe ratio being considerably overstated in the case of positive serial correlation and considerably understated in the case of negative serial correlation. The other thing is that standard deviation does not equal risk. It is commonly used as a risk measure, but standard deviation by no means equals risk. This is perhaps best explained with the following scenario. Let's suppose we have a strategy that one trades very small movements and over very small periods of time. It does this during low volatility hours, but with very high leverage. If the market barely moves, then the standard deviation here will be minimal, but the strategy will have traded with a very high leverage and hence taken on very high risk. The Sharpe ratio is also only applicable to strategies with low value at risk. It can only really be applied to strategies operating with low to mid-sized VAR, for example, lower than 20% to 30% value at risk at 95% confidence at maximum. So to demonstrate this, let's suppose a trader has a fantastic win ratio, an amazing win ratio of 100 to 1. But this trader risks all his capital on every single trade. Given these dynamics, it is inevitable that the trader will lose all his capital at some point. And the Sharpe ratio up until this strategy's inevitable demise would have been quite spectacular. More alarmingly, though, it could have misled investors using it as a performance measure to make ill-fated investment decisions into such a strategy, despite its apparent historical awesomeness. However, if this same trader risked only 10% of his capital per trade, that is, lowered his or her strategy value at risk as a result, he or she would likely make consistently spectacular returns without self-combusting, as would be the case with employing all capital into every single trade. At Darwinex, we have our own proprietary measure of return risk since inception for Darwin assets, and it's a metric that is similar to the Sharpe ratio because a Darwin's risk is capped at 10% value at risk at the present time, for which such a ratio is practical and adequately applicable. Because the Sharpe ratio depends on the underlying strategy's risk, on its own, it cannot adequately judge a strategy's performance. Alternatives for performance measurement in this case are, well, if the objective is to measure trading strategy performance, it makes more sense to estimate a trading strategy's performance compared to random strategies trading with the same risk profile, and also how much risk a strategy can handle compared to random strategies trading the same asset profile. In our analytical toolkit at Darwinex, the performance investment attribute measures the former, that being a trading strategy's performance compared to random strategies trading with the same risk profile, while return risk since inception measures how much risk a strategy can handle compared to random strategies trading the same asset profile. And for more details on these, of course, you can visit the Darwinex website and go through our Help FAQ and other resources therein that enable you to understand the specifics of the performance and return risk and since inception attributes. Hope you found the contents of this podcast useful. As always, if you did, please do consider sharing it with your friends, colleagues, co-workers, and social networks. We greatly appreciate that. And if you have any thoughts on the contents of what we discussed today, feel free to leave a comment below this podcast if it's on a listing where you can do so. If not, you're very welcome to visit the Darwinex community forum and leave your thoughts there for us to gather and respond to. If you have any questions, we'll get back to you as soon as we can. And once again, hope you enjoyed this podcast on the issues inherent with using the Sharpe ratio and alternatives, considerations, as well as alternatives to the Sharpe ratio for assessing trading strategy performance correctly. Thank you.